Christopher, it is such a great pleasure to have you join us as a keynote. Come on up, and we'll transition right into your keynote. And really looking forward to learning more about how to pick a proper junior, because I can still learn a lesson or two here as well. So, Christopher, thank you so much, and
thanks, Kai.
Good luck.
Good morning, everyone. Thanks, Kai, for the invitation. It's a pleasure to be here today. And we are doing a little bit of digging today. So typical mining stuff, digging into junior exploration. And I just want to know, like, who of you in the audience is like an investor right now? Please raise your hands. Okay, so it's quite a lot. And who of you is making money in the junior mining space? Okay, so that's, let's say, half of it. And hopefully with my talk today, we can improve this probability of success, because this is what the industry needs as well. So I also brought for you a questionnaire, which you guys can use afterwards. I will hand it out. There's like questions on it, which you can apply for the interview with the company, some ideas, just to better understand your target investment and potentially say yes or no. Next slide. As I said, I'm not doing any investment advice. It's pure informational purpose. And the presentation is designed for retail investors. Yeah? So people who don't understand the sector, who are not technical driven, and I want to give you some investment strategies how you can improve your investment probability. So to set the stage, in what sector are we living in, or what's the junior mining sector looking like at the moment? For the last 20 years, the major mining companies have mostly closed their exploration departments, and the industry is lacking major discoveries in nearly every commodity. So we have the big mining companies now looking to replace their production profile, looking to replace their reserves. And this means they are shifting towards tier 1 discoveries. And so should we as investors. We should also focus with the same approach like the mining companies, looking at the best assets out there. And we at Incomet, we're looking just at the asset base. We are very technical driven. We don't believe in gold bugs, silver bugs, interest rates, and all kinds of stuff. We're looking at the asset. And good assets will always survive. And this is one of the investment strategies you should also follow. Then on the other side, there's way too many listed companies out there. So we have around 1,500 listed companies in North America, in Europe, and Australia. Yeah. The companies you see here today, it's just a very small representation of that. And further to that, the success rate to make a tier 1 discovery is less than 1%. Yeah. Everybody, of course, is promising the big discovery, the big next mine, but the chances and the statistics by Rio Tinto Exploration is less than 1%. Yeah. So keep this in mind for your investment strategy as well. And everyone you are meeting here or at other conferences or roadshows, everybody is promising you the blue sky, the next big discovery, we are the next takeover target. So be very aware of that. Yeah? And then on the other side, you have the junior mining space complaining about not sufficient generalist money being in the sector. And I can tell you why, because the sector is not making money for these generalists. They are leaving the sector, they're going to crypto, they're going to the public, to the equity markets. And if they would make money in the sector, they would remain in the sector and continuously invest. And this has to change. So that's certainly another issue the industry is facing. So just to summarize here quickly, we believe there's only 100 good technical management teams out there. Yeah? So the chance to pick the right team is less than 10%. And then there's 1,500 junior mining companies out there. Everybody is promising the next big mine and discovery, but as I said, the chances are extremely low. And then you want to build a portfolio of 20 companies. So for like a private investor or a retail investor like you, it's nearly impossible to make the right investment decision in such an environment. So what can we do to narrow it down and increase your probability of success? And this is what I will talk about today. And also, hopefully this questionnaire or Fragebogen can help you a little bit to improve your investment. One challenge in the industry is also that the management is not aligned with the public investors. Yeah? So this graph, I try to explain on an example here. So that's the capital funding structure of a typical junior mining company. Yeah? So on the x-axis, you have the timeline. And in this case, let's say we have 4 financing rounds. Yeah? We have the founders round, the seed round, the pre-IPO round, and the IPO round. And in yellow, you see who is providing the capital at each of these funding stages. So let's assume there's a bunch of geologists, a good technical team coming together. They have an idea, they have a project. They're setting up an Ontario registered company. They're setting up a BC number company. They're raising some small money, issue themselves founder shares. In this case, it's 1 cent shares for $150,000. With this money, they pay the legal cost, company setup, then they're going in the next phase to their family, associates, close business partners, and then they are raising $500,000 to get the company going at like 5 cent valuation already. Yeah? So they hire people, they get a website, they get the presentation done. Then afterwards, they're doing the pre-IPO financing. So they're going to the brokers, to institutional investors, to some big well-known names, offer them 20-cent shares to raise like $1 million. And then afterwards, the company is doing the public transaction where they approach the public market, retail investors, smaller high net worth individuals to raise at 50 cents, for example, $5 million. At IPO, this example company would have 20 million equity valuation already. Yeah? And in the bottom, you see what the issue is. We are assuming the management who has founded the company has not participated in the following financings, which means they own 38% of the company at IPO, but they only provided 2% of the capital for the company. And the retail investor, the public investor, they provided 75% of all the funding for the company, and they own only 25%. I'm not saying this is for all the industry, but I mean could be quite a common example, and you see that. So the management is not aligned with you in this case. So always make sure the management has at least a higher share price than just sitting on the founder shares. And I think that's really, really important for you to understand. If this is not the case, don't invest. There's no point. You have 1,500 other companies to choose from. Yeah? So that's, let's say, the environment we are working in. And now it's the technical side. Yeah? Mining projects, they face a lot of modifying factors. A modifying factor is like a term which is used in the mining industry, which is a risk in the end to the project. And this can be technically, environmentally, legally, financially, and so on. So this comes on top. Mining is certainly one of the highest, most risk industries, in my eyes, on this planet, because it's so diverse. Yeah? Then we have high competition in established regions. If you go to parts of Quebec, parts of southern British Columbia, if you go to Nevada, like most of the areas are already staked and have been explored for like 50, 100 years, 200 years. Yeah? So we believe most of the next big major discoveries come from remote areas or from regions which are geopolitically challenging. And that's, of course, another risk which we have to face. Yeah. In addition to that, most of the future discoveries will come from undercover exploration. Yeah. The easy-to-discover deposits at surface have been mostly found in the well-developed exploration destinations. So people start now looking undercover, yeah, in Australia or like in very remote areas in northern Canada, which is covered by glacial till. And then mining is super long-term. Yeah? We are talking about an average lead time for each mining project of 17 years. Yeah? And you as an investor, you don't have this investment horizon, and you should not have this investment horizon. So the next slide is most important because this is where I want to give you an investment strategy to optimize really your return. And we don't have an investment horizon of 17 years. So this slide is certainly complex, and I will speak in the next few minutes in detail about it. So again, on the x-axis, you see the timeline. And this describes the typical mine life cycle. Yeah? In German, Bergbau-Lebenszyklus. And it's divided in 3 stages. So normally you have the early stage exploration, then it goes into late stage development phase, and then you go into the mine stage or the operation of the mine where the asset is then producing the first cash flow. In the junior exploration phase, the first one, this is what I talked earlier about it. There's a company coming together, some geologists that have an idea, they have a license or a concession agreement. They're founding a company, they are preparing drill-ready targets, then they're drill testing it, and hopefully they're hitting the holy grail, and everybody makes money in the end. This is what they promise you. Yeah. Then it normally goes to like a maiden resource. So MRE is the mineral resource estimate. After that, the project normally goes into, let's say, resource conversion drilling, technical studies from PEA, PFS to DFS, resource development studies, and so on. And they kick off with the permitting. And then it goes into the senior mining stage, where the project is actually built, and then the mine becomes reality, and you have the first cash flow. So where would I recommend to invest if I have no expertise or I'm not doing this 24 hours like I do? Yeah. The best investment strategy would be the one in the mine stage. Like, yeah, I'm not sure if I can show it, but on the right side, that's the yellow part of the line. So what I would recommend, you only invest in a mining company or in a junior exploration company if the project is fully permitted, project finance is closed, and they have a final investment decision by the board of directors, which means they would break the ground, they would start building the mine. This is when you invest. And you are just waiting for 2.5, 3 years, and then the stock will most likely automatically increase over this period because the market realizes, okay, they're coming towards cash flow, the project is getting de-risked, and this is what is a very secure investment idea. The average return in our case, we have done 16 of these deals, is 87%. Yeah? So you can just sit back, hope that the EPCM contractor is doing a good job in executing the project on time, on budget, and then you just exit the stock. Yeah? The timing to exit the stock, it's sometimes tricky. Yeah? We recommend you sell the stock when the company announces wet commissioning or first concentrate, first gold. Then you normally should just exit the stock. Of course, you could remain in the company invested, but then there's more challenges coming with like ramping up to commercial production. They need more run of mine, mining needs to increase, and so on. So I would rather exit the stock before. If you apply this strategy, I think you have a safe investment in my eyes. If you want to invest in a mining phase, the best would be just buy an ETF, gold miner, copper miner, uranium miner. I think you don't have the expertise most likely to do analysis on producers. It's also quite a complicated exercise. During the development phase, don't invest. There's no point really to invest. The company just needs money to do studies, to do technical work, to do permitting. You have not the technical expertise to do all the to read the technical reports, to analyze where the project is. Yeah, in my eyes, there's not really any point to invest during this phase of the mine life cycle. And then the other one is, of course, the early stage exploration, the discovery play, yeah, where you invest in an exploration company who promise you a drill testing of targets they have generated, and hopefully they are hitting high-grade intercepts, which could result in the following years in a major discovery. As earlier you can come in to this company, as better it is. As I said earlier, if you can invest in the private company already, why not? Valuation is low, you get cheaper shares, and you just have to hope that the company is making their going public transaction. Problem is, if you invest pre-IPO or in private placements, like retail investors in Europe facing challenges with the brokers and the share registration and subscription agreements and so on. So this is the hurdle for private investors in this case. But if you have the opportunity, I would recommend to do that. If the company is already public and the drill program to commence, get into the story, and then just watch the drill results coming out of that. For the gold space, what we look at greenfield projects, so projects which have not been explored before. And the first few drill holes should result in a grade times thickness, we call this GT factor, more than 75. So let's assume they're doing a maiden drill program. The first drill results come out, first 2,000–3,000 meters, and there's no intercept of 75 GT value. Yeah? So GT value means you just multiply the grade times the thickness. In this case, you can use the reported thickness. We are not bothering about true width and all kinds of other stuff. But if there's no intercept in this program which results more than 70 GT, I would exit the stock. I would look for the next drill play, the next discovery play. So I hope this is clear. And of course, it's a very radical approach. We at Incomet, in our fund, we are not doing this. We invest along all the mine life cycle. But we have the technical capabilities to cover most of that as well. The questionnaire I give you. So I picked some of the questions which I believe is very important, and it's easy for you to ask and to understand. Yeah? So the first is asset ownership. Ask about, is the asset owned 100%? Where does the asset come from? Is it a joint venture? Is it an option? Is it an earn-in? Yeah? The best is always they stake their ground. They can justify why they have selected this area. Yeah? A joint venture is also important if both funding partners or both JV partners putting money on the table as well. Yeah? If it's an option or an earn-in, always ask where the asset is coming from. Yeah? It's very common that geologists out of South America, Africa, Europe, going to Vancouver and Toronto, approaching successful management teams with an asset and telling them, can you help me to bring this public? And then for this earn-in or option, mostly the North American company needs to do cash payments. The vendor, the person who brings the asset, sometimes gets very cheap shares as well. So be aware of that. Yeah? Ask about it. It's super important. Because the junior mining company is not always openly telling you the ownership of the asset. Yeah? Sometimes you have to ask or dig a little bit deeper here. Asset history, very important as well. If we invest in the early stage phase, we want to have greenfield discoveries. Yeah? We don't want to have another asset which has been drilled 20 years ago or 5 years ago. We want to look for greenfield discoveries. And that's also very important. If they have an asset with asset history, then ask why they believe there's still a discovery to be made. Of course, there is examples like Great Bear. Great example, this asset has been drilled for 20 years, and then just the geological framework change, suddenly discovered an 8 million ounce deposit. Yeah. But still be aware of that and rather stay away from projects which are recycled again. Yeah. Sometimes the same project appears at a different name, under a different company, and we try to stay away from these stories. Experienced management team, of course, I think that's clear to everyone. There's no question about it. On the questionnaire, I have a list of successful management teams which you can follow. Of course, it's not comprehensive, but I mean, there's some ideas on it. Geographical focus, also very important. The management team sitting in North America, but having assets in PNG, in Africa, in South America. What's the connection? Yeah? Why do they have an asset in a different jurisdictions they are living in? And who is the person on the ground? Yeah? Very important. The country manager, the general manager in the country is the key person as well. He has to manage the ministry. He has to manage the community. He has to do the day-to-day business, the employees, the exploration program, everything. And if this person is not really there, then you should be really alarmed in my eyes. And also, if there's a local partner or like a local general manager, where is this person coming from? Is there a good trust relationship already established? Do they know the person, or is it again just like someone they hired and most likely is not the trust built so much as they needed. Deal flow, of course, very important as well. Of course, you are attending the Deutsche Goldmesse today. It's just a small representation of junior mining companies, but look at more companies. Most companies we invest in, they don't even show up at conferences or at newsletters and so on, or roadshows. So make sure you get a lot of deal flow, or you see a lot of news flow from other companies as well, and you're not just investing in like the 20 companies you are presented. Yeah. Then when you look at the presentation, I'm not asking you to understand geological maps, but just get a good feeling about it. You know, do they understand their asset? Do they have some maps which they can justify the drill program, and is the targeting at least understood? And then, as I said earlier, the drill results, we are quite radical with that. If the first 5,000 meters of a maiden drill program don't intersect a GT of 75, we are exiting the story. For us, this discovery play is already then over. So that's just a recommendation in this case. We also try to stay away from super narrow, high-grade veins. It's a challenge later to put a resource together. The best example is newfound gold right now. They are struggling big time to understand the system. And better is always wider intercepts, high grade, or like really wide intercepts plus 100 meters with like, let's say, medium grade. And also remember, the reported grade is most likely not the true width of the mineralization. But that's, again, I think too technical in this case, but I mean, this is just a small refinement here. If the junior mining company is presenting themselves as having a tier 1 deposit, just use this metrics. Is it 3 million ounces measured indicated? Has it at least a 10, 15 years life of mine? Is the all-in sustaining cost less than $1,500 US? So can the asset produce 200,000 ounces per annum? And that's for us, let's say a tier 1 or tier 2 asset, which most likely will attract a major company, or the project is able to attract project finance. Yeah. The project finance companies or like project finance institutions like funds, banks, royalty companies, streaming companies, they have one of the best technical teams, and they only provide project finance if it's a robust project. And if you apply these very high-level matrix, then it could help you also to identify already a good target. Project location, very easy. Get a pin on Google Maps from the management team or look it up on yourself. Get a feeling for the location. Is there like artisanals running around, settlements close by, big rivers, big lakes, anything? Topography, big mountains. All of that is very important as well. And you get a feeling for it. Could this even a mine? Could this be a mine in the future? What would be potential permitting issues and so on? Yeah, you don't have to dig into it, but just get a feeling for it. Look at satellite image. It's quite easy, 5 minutes, and you have a good understanding on the project location. And then when the drill results are coming, look for long and cross sections in the news release, as well as plan view for the drilling collars. If the company is not providing long sections or cross sections, we are staying away from this company. Super important, because you want to, let's say, roughly calculate a volume at least, what they are drilling out. Yeah? It's super easy, length, width, and height, and then you just apply like a specific density of 2.5, just a very rough number. But if these sections are not there, it will be very hard for you to understand what the potential size could be. So yeah, I will give this out to the investors afterwards, and yeah, happy to discuss it. So what are the key factors? As I said earlier, management, technical expertise is key. There's less than 10% of the management teams out there, in our opinion, which are running good exploration programs. You need promotion as well. Like good promoting companies, of course, can raise equity, and they also, of course, let's say, are less dilutive because they're getting market awareness and so on. So promotion can be good, but it's also not always good. Yeah? It's a fine balance, but I think Kai and the team can most likely better explain what the balance would be in this case. Then disciplined project selection. Many junior mining companies are just holding on to their land package. If there's nothing there or they have not hit anything, give it back. There's no point to keep it. Yeah? And this kill it or drill it approach is also lacking in the industry. Yeah? And Rick Rule is a big fan of this as well, as we are. If there's nothing there, don't keep it. But it's good to market, of course. Big land package, lots of potential. But on the other side, we rather look at, okay, has the company found something? No, okay, they're moving on to the next target. And there's no problem to admit that the target was not successful. This is normal in the industry. Yeah? And if people are honest about it, we are much appreciated of this. Okay, so a quick conclusion here. Manage risk, avoid fear of missing out. Conduct a high-level due diligence at least. Get a feeling for the management. And try to avoid the typical pump and dump plays, which are out there, unfortunately. Timing, as I said. Be strict with these investment entry points and have a clear exit strategy. If you follow this, you're already quite on the safe side. Yeah? You can certainly de-risk your investment approach. And stay disciplined, very important. Think long-term. Such an investment, early stage, takes 2-3 years for sure. Yeah? And give the management team also time to answer geological questions, to do the work programs they are proposing. Yeah? Nobody expects you to be invested for the whole development phase and the mining phase afterwards. Just look at the 2 years for construction and like 3 years for the early stage. This is our recommendation. Don't chase stocks. Yeah? High-grade intervals will be all over social media, and the share price is normally already running up quite quickly. No problem. Just sit down, analyze the drill results, and wait for a few weeks. The share price normally comes down, and then it flattens out, and then you should buy. Don't have the fear of missing out and buy when the stock is running up crazy. I see a lot of investors doing it, and then they are sitting on top, and then the company is financing later at a lower price for the follow-up program. As I said earlier, target tier 1 deposits. This is what will survive any commodity cycle. Good assets will always be key. Yeah? So this is what we do. Pure technical, tier 1, tier 2 assets. This is what we are focusing on. High-grade, long-life assets. Another idea would be to use prospect generators. That's, let's say, a more risk-averse investment approach. That's junior exploration companies who have joint ventures with major mining companies. And these major mining companies are paying for the exploration. And the junior mining exploration company has the upside of having shareholding or a potential royalty in a discovery. And then always remember, every management team wants to make money, and so do you. And I think that's really key. Align your goals with the management and make sure they are aligned with you as well. Because good, successful management teams out there, they're not having only one company they're presenting to you. They already have a pipeline of private companies they are working on, which will be the next deal. So ask about it. What are you working on the side? What is the next story you are working on? And I'm pretty sure some of them will tell you, yeah, we have this private story, copper in Peru, copper in Argentina. Can I invest in there? Can I be a part of your story? I want to be really a good shareholder. I want to be part of this new story. Ask for it. And most of the good teams, they have 2-3 deals on the sideline as well. So I think that's really my recommendation to specifically retail private investors. This applies not to like professional institutions, of course, or funds, but I want to give you a little bit a better idea on how you can better, I think, invest in the space. So I will hand out the questionnaire, whoever wants it. And if there's any questions, I'm available. And I hope this gave you a little bit more insight. And good luck out there. And hopefully you guys can make some money in the sector and bring it back to the sector as well, because that's key. Yeah? We need private investors who make money in the sector and they remain in the sector. And that's super important for us. Okay, thank you so much. And